All right, all right, all right. How's everybody doing? Great to have you here the first thing in the morning. I got my President's Club jacket on for presidents, red, white, and blue. And we had a big holiday yesterday, and so we didn't have any class down at the university. Class is tonight. Tonight at the university, we have class. So for those of you who are registered, come on down. Can't wait to see you. We'll see you there. And for those of you who are here for the university class, we got a lot of great things to share with you today. So I'm looking forward to that. And we're going to get started here. First of all, the first thing I want to do is I want to just kind of pull up that little, I want to pull up the little marquee. You guys know that I always like to start with that. Lately, you never know what we're going to do here today. One from one day to the next, right? We're going to have lots of fun, though. Stop putting cash in, start pulling cash out. All right. So, the whole idea or the concept that we're talking about here is building ourselves a UBI, Universal Basic Income Portfolio, right? We always talk about how much are you investing in the market? How much are you putting in? How much are you putting in every month? Oh, you got to put money in for the rest of your life, right? That kind of thing. But we never never talk about taking money out. It's all about putting money in. When are you going to put money in? Take money out. Well, I'm going to take money out when I'm rich beyond my wildest dreams. So I'm going to take money out when I retire. I'm going to work my fingers to the bone until I retire. When I'm 70 years old, maybe I'll start taking some money out of the stock market. Well, I hope that there's some there for you when you get 70 years old. And I hope you don't need it because you got so much money, you don't need to pull any out. But that's not the case for many people, right? Many people, as we talk about in class, they need to make a living off the stock market today. And that's what I like to do. I like to think about taking money out of the market instead of putting money in. Now, it takes money to make money. You can't, just get free money. That doesn't work. Although sometimes it feels like when we invest in the market properly and do it, strategically, it almost feels like free money. It's like, you get a little notification on your phone one day and you're like, oh my gosh, I just made $1,200 today on those dividends. And that's a pretty nice feeling. And that's kind of like pulling money out, right? So if you want to have a little extra cash coming in, we're going to work on building ourselves a portfolio that pays us as opposed to us paying them. All right. And that's the name of the game. Start pulling money out. So we need to have some opportunities to do that. Now, one of the problems that we have when we trade is, well, this is one of those problems right here. Sometimes markets go down. Now, I know you never did consider that part of the side of the coin, that markets sometimes go down. Yes, they do. And so what we have to do is we have to evaluate our portfolio from a standpoint of not how much your money, your strategy makes when we're in good times, right? We have to know how much our strategy is going to not lose when we're in bad times. All right. Now we don't always know when these bad times are going to come. I mean, we got technical analysis, mathematical modeling, we got indicators, we got Elliott Wave, Fibonacci, we got delta cones of probability. We got all kinds of mathematical models to help us identify when those times might occur. And so we can prepare for them. We have time, right? We have time on our side. We're like, okay, the markets are doing this. It's above this average. It's this, that, and the other thing. And we can say we got a little bit of time. We probably the market's going to go up a little bit more. The fundamentals are good, right? But sometimes there's catastrophic failures. There's what we call the black swan event. The market just flushes one day. You have no idea why. You didn't expect it. It just was one day decided it didn't want to be a happy market anymore and decided it wanted to be a very sad market. And you were getting up, drinking your coffee in the morning, You walk into your little computer and you turn it on to see your portfolio only to find that it's zero. It's like, where did everything go? How do you guys like my mug? That's the White House mug, under construction mug. That pisses so many people off that they're actually building a building in Washington D.C. Oh my gosh, I was in Washington D.C. once when I was 12 years old on now I'm so mad that they're building another building there in Washington D.C. Why? Yeah. Why do you care? Why do you care? Nobody cares. They just want to care. It's terrible. Did you hear all the Democrats said that they're gonna, if they get into office, when they get back into office, they're gonna tear it down. Tear it down. Okay, they all raised their hand on stage. If you get back into office, will you tear down the new ballroom for the White House? Yes, I will. I will tear it down. Okay, well, construction one way or the other. Some people build things, some people tear things down. I guess it depends on your party. Pick your party. So I got my mug. Anyway, just lost half the people. All right, well, there goes half my audience. That's okay. We're here to build things. That's what we're here for. We're builders in this building. We're builders in this class. We build things. What we're going to build ourselves a portfolio. All right. A nice, big, beautiful portfolio that doesn't die when markets go down. Now, I've been trading for a very long time, and I made a mistake the other day. What? About in end of October, I made a little mistake in that I anticipated, and I'm going to tell you the mistake that I made. All right. It's published in Pit News Magazine, so it's not like I'm revealing something that I've never revealed before. We published it in Pit News Magazine, one of our trades on a company called Misty. And Misty, MSTY, is the Yield Max version of MSTR. MSTR being a software firm, but that software firm, what's very unique about MSTR is that they have a huge balance sheet of Bitcoin. And this is them. This is their stock. And as you can see, making money. They had a little rough time back here. Bitcoin went down a little bit. And you'll notice that because they have such a large amount of Bitcoin, their stock basically moves with Bitcoin. So if Bitcoin goes down, their stock goes down. If Bitcoin goes up, their stock goes up. But they're actually a software company, and they actually do have products and services that they offer. Very successful company, but institutional software, I believe. But you can see right down in here, this is where I got into this market. I got in right down in here, and I put a lot of money in there, but like $100,000. That's a lot of money to me. Okay, so $100,000 in there, and I rode this thing all through here, and during this entire time, this thing, now I didn't put it into MSTR. I put it into its companion. All right. So pairs trading, we have pairs trading. Pairs trading means we have two stocks. We do all of our technical analysis. We look at all the market. This is the market that we stare at. But when we put our money into the market, we actually put it into MSTY. And the reason we do that is we have the two funds, and the two funds work simultaneously, right? They work together. But one fund pays a really high dividend while the other fund pays no dividend at all. And so what we're doing is we're taking profits out along the way. That's the whole idea of a dividend paying ETF or an exchange traded fund, is that they're paying a high dividend, which means that if the market goes up, well, the net asset value of the stock, of the underlying ETF, generally doesn't go up very much because it's taken all the profits out. All right, it's taking the profits out and giving it to you. This is where we take money out of the market as opposed to putting money in. You have to put money in the first place, but then you want that money to work for you so it can take money out. Now, the way they do this is with a covered call strategy. So if the market's going up, covered calls keep paying these big strategies, and you get to participate in some of the upside potential. If the market explodes up, then you don't get to participate, but it can go up pretty good, and you still get to participate in that upside potential. But the covered call kind of caps huge explosive growth, but you trade that huge explosive growth for, one in the hand as opposed to two in the bush, because two in the bush doesn't happen very often. And so you're like, well, I'll just take the one in the hand right now, sacrifice the possibility there might be a two in the bush. And even when the markets are going crazy, you can see even this market that is traditionally speaking not meant to go up because it's just giving you the cash, taking the money out along the way. You put your money into MSTY, it technically shouldn't go up. But even this market was so powerful, it just kept going up, 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 and up. Okay. And they were paying you these huge dividends. And I was part of that. I was in there. I was doing this, man. I got in here with $100,000. I make more money than I ever made in my life. I couldn't believe it. I was getting $10,000 dividends. It was like $8,000 dividends, $10,000 dividends. It was really nice during the heydays when that thing was going to the moon. And we really liked that. And then, of course, I didn't take the money and put it back into the same fund. I started up a whole bunch more funds. There's like Palantir is one, there's Amazon is one, Netflix is one, Google is one, Microsoft is another one. And you can just put your money into these other pairs trading, right? You don't put it into the actual underlying stock. If you want the dividend, you put it into the pairs trader, and then that's the one that pays you the dividend. And so the dividend stocks just kept making me more money. I ended the year and 2025 up 62% annualized return. That's a lot of money to me. I mean, 62%, that's pretty good, considering the S&P 500 did what? Well, I think it was actually a little higher than that. It's a little, I want to say 18%, but I can't remember if that's the exact number or not. It was higher than usual. Usual is 10%. So it was much higher than usual. So and it was a banner year. I want to say 18%. I don't know. Maybe I'm a little off there. Maybe it was 12%. We have to go look. I can't remember the number. But anyway, the S&P 500 is kind of the standard, right? That's the bellwether standard that we always measure everything against. That's why we have the formula, what we call the rule of 72, right? So the rule of 72 says if you take the return divided by 72, or take 72 divided by the return, you're going to get how many years before you're going to double your money, right? And if you do it at 10, you're going to get 7 years. So it's 10. A 10% return is what the S&P 500 generally returns on average over the life cycle of the S&P 500. Therefore, you're going to double your money every 7 years. So that's why we always look at that as the benchmark, because we're like, if our trading strategy can't outperform the 7-year 72 rule of 72 in the S&P 500, then we just will go put our money in the S&P 500, because why do anything else, right? So if you can't beat the S&P 500, why do anything else? If your real estate is not beating, a 10% annualized return, you're not doubling your money every 7 years, why are you doing real estate? Just go put it in the S&P 500. It's a heck of a lot harder to work a real estate venture than it is to just go throw your money in the S&P 500 and call it done. So that's why Warren Buffett says most investors should probably just go put their money in the S&P 500, because it's very difficult to outperform the S&P 500, make 10% annualized, double your money every 7 years. So the fact that I did 62% last year made me happy. All right. I was pretty happy with that. Now, I'm not at 62% right now. The markets have gone down. All right. The markets have gone down. So let's go look. I think I have it up right here. This is my actual real money portfolio. You can see I'm up 58%. 58%, it's gone down from 62% down to 58%. And I got two markets here, so that two accounts here. One is at 68%. So this one, this is my traditional IRA, and it's at 68.14% right now. So that's a little bit better than this one here, which is at 58%. Now, what's the difference between the two? Well, honestly, one I manage a little bit more closely. I play with it more, move stuff in. The other one, I just kind of forget it's there. I put my strategies on, and then I forget they're there because I'm over here focused on this one. And this one made 58%. The other 68%. I'd probably be better just to put my strategy, walk away, and quit fiddling with it. Right? Sometimes when you fiddle with things, you don't make them better, you make them worse. And so it seems like that maybe I need to take some of my own advice sometimes and lay off a little bit. But I don't know. I like doing it, right? I'm trying to make it better, trying to learn. I've been doing this for 40 years, and I'm still learning, believe it or not. Yeah, I got lots to learn. I just feel like a brand new trader at 40 years. But this stuff is all new. All these high yield funds, pairs trading. Well, we've been doing pairs trading forever. But high yield funds like this, these are brand new, right? Well, they've only been around for a couple of years. And so I'm playing with them, trying to make them work. So that's the name of the game. And so what happened here is, back circling around, doing my little Donald Trump weave, this market came tumbling down. Now, when it came down, tumbling down through here, I wasn't in bad shape, because what happens is when you're doing a covered call strategy, in this situation in particular with these high yield funds, those dividends that keep coming in are such a high yield that every time the market goes down, the dividend would come in and it would cover the loss, right? So I would lose 10,000, it would make 10,000. I'd lose 10,000, it'd make 10,000. I'd lose 10,000, make 10,000. I wasn't losing anything. I just had, it was beautiful. It was just a magical thing, going through, just sitting through a market and not touching it, and watching the dividends pay for the slow decline. And then it kind of come along here and it started going back up and I started making money again. Oh, now yeah, I made $2,000 on the growth and I made $10,000 on the dividend. I'm making money. I'm paying back anything that I did lose in the downtrend. I was making it back and making it back. I didn't even care if the market went up because I was getting such high dividends that if the market just went sideways like it did right through here, hey, I was still making these big dividends. And the growth was so tiny losses that the big dividends paid for it. And I was in love with it. I was just like, oh, this is the greatest thing since sliced bread, right? I'm going to stop saying sliced bread. I'm going to start saying cinnamon bread. How's that? But then something catastrophic happened. All right, that catastrophic thing happened. And here, this market just come flushing down like a bad broken toilet, right? I mean, this thing just went straight down. And then I started losing money and the dividends couldn't keep up, and the more money and the dividends couldn't keep up. It was still paying dividends, but the losses became so big and so bad that they couldn't cover the losses. Oh my gosh, that is terrible. Oh, you're losing money. You're losing money. Now, I didn't lose all the money that I had made. I made so much money in here and put it into other funds that were still kicking back big returns as well. But still, you don't want to lose $100,000 in a 6-month period of time. It's very painful. Okay. And that's what happened to me. And so I go back in my history and I say, you know what, Lan, why are you so dumb? You know how to protect yourself to the downside. You know what a down cycle in a market is. You know how to read charts. You know when this stuff is going to happen. This is your specialty. This is what you've done your whole life. How did you let that happen to yourself? And you know how I let that happen to myself is that I got complacent in the fact that the thing was paying such high dividends that even when the market was going down, I was still making money. And I went and I created a calculator. And I know some of you have been asking about this calculator. You're like, Lan, show us your calculator. Here's my calculator. I went and created a calculator to help me determine this because I don't want to make the same mistake twice, right? I'm a glutton, but I'm not a glutton for punishment. All right, let's see. Where's my calculator? It's in this one right here. So I created a calculator. Is it this calculator? Yes, that's one calculator. But look at all the calculators I've created. I've created this calculator, this calculator, this calculator, this calculator, this calculator, this calculator, this calculator. And I'm going to teach all these calculators to you, and I'm going to give them to you, and I'm going to let you have them. I'm going to show you how to use them, how to get to them. They're all going to be part of Pit News Magazine. So if you're a subscriber to Pit News Magazine, get all these calculators that I've created so that you can do all this different type of research, work, figuring out. I'm working really hard. I worked all weekend on one calculator for you. All right. And no, they're not going to be a fortune. You're not going to have to pay $1 million for them. They're not going to be $10,000 a piece. They're little calculators that help you calculate some of these strategies that we talk about down at the university, right? And so the way I like people to show that they're interested in this is just subscribe to Pit News Magazine, and that includes all the calculators. Now, the calculators these are some of them. I got calculators spread all over the place. They're like it's a mess. So I've decided I'm going to take and put all my calculators under one window. So you can just real simple, easy, right? Just click, 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 click. Get all the calculators, and then I'll have all the help files. So it shows you what the calculator's for. Of course, you're taking my classes, my courses. You're coming to my YouTube channel, the labs of the university. And so we'll just keep working with it. We'll just keep doing it, and we're just showing you this stuff and helping you. And I have to admit, at some point, I'm tired of teaching you how to use the calculator. At one point, I decided I'm getting frustrated. I'm just going to show you the answers. How's that? I'm just going to give you the answer to the calculator. So you don't even have to use the calculator. You just go and say, Lan did the calculator on MSTY. What was the answer? Oh, that's the answer. So he just gives me the answer. I don't even need the calculator anymore. I can use the calculator if I want to go do it on something other than what Lan gave me. But Lan just did like 10 of them. And those all look pretty good to me. I just take the answers that Lan did. You can do that because if you come in here, watch, I have an answer table for one of these right here. This is just one answer. I got here's just 3 calculators right here. I got so many calculators. Like I said, I got all these calculators up here too. And we're going to be put all these calculators into a single window that you can get to, and with all the instructions and everything. Plus, you're going to take my class and show you how to use the calculators. All right, so we're going to come in and we're going to say, how much income can I earn? Or how much do I need to invest? You can look at this from two different standpoints on this calculator, all right? How much income can I earn? Let's just put that in there and say, well, if I have $10,000 to invest, and I put that $10,000 into some of these high yield funds, how much money can I return? So I just give you all the answers. Look at that. There's all the high yield ETF funds. Now, this was updated as of February 6th, 2026, so it's pretty current. You can see that Carvana, CVNY, and the underlying or the pair is CVNA. So that's your pairs trading, CVNA, CVNY. Now, right now, the yield on that is 126%. All right. 6-month gain, though, it's losing money. It's down 8.47%. That's not good. But if you have the yield of 125 and you subtract the gain of 847, you get a gain plus a yield. You're still making 117% annualized return. That's a pretty good return on your investment, wouldn't you say? That gives you a monthly income on your $10,000 investment of $1,000, or annually, that's $12,000. That means that you would have the rule of 72 rather than waiting 7 years for your money to double, which is what would happen if you were in the S&P 500. If you did this one and things stayed the same, right? Not that they ever do. You would have double your money in less than a year, in about 1 year. That's 7 times faster than the S&P 500. Now, the risk on that a little bit higher, right? Why is it high? Well, you have to pay for more money it costs, the more volatility it is, the more volatile it is to make that kind of money. It's not like it's not a bank CD down at Cash Valley Bank, right? I mean, Cash Valley Bank gives you 3%. Why? Because there's no risk. You get your full guaranteed, right? Unless Cash Valley Bank goes out of business, and then the federal government comes in, steps in up to $250,000 and guarantees it for you at $250,000, right? So if the government doesn't go out of business, so there is that. Nonetheless, how's that all work out for you? Well, this is a very high risk strategy, but nonetheless, it pays very high returns. And so we can come down and look at the next one. Well, that one's a short position, which is paying a lot right now because markets are flushing like a toilet, right? And this is called Winter, and this is Misty, MSTR. Now, this is what I should have done. This is Lan taking a lesson out of his own playbook, and I should have protected myself to the downside more aggressively. Because I have a saying that I always teach. It's like, Lan, listen to the cobbler's kids, the shoemaker's kids are always the ones without shoes, right? Shoemaker's kids are always the ones without shoes. Well, Lan didn't listen to his own advice and didn't protect himself to the downside with that MSTR trade, because I was just expecting the big dividends to pay off. All right. So this is Winter. This is actually, if I would have been doing my due diligence, I would have put my money into WNTR, which makes money when MSTR goes down. That's a short position trade. You can do that. All right. So they've got offsets on some of these. Here's another one, Coin. If you were in Coinbase, right, and Coin went down, well, and you put your money in fiat, you'd have made money going down. And that's how it works. So there's a few of those that have those, and you can see that these markets are flushing like toilets, and so those end up percolating up to the top of the trend, top of the list, because hey, markets were flushing like toilets, and that's how these two pairs trades make money. So you got MSTR and Winter, Coin, and fiat. So you can see that if you'd have put your money in fiat over the last 6 months, the yield would have been a 78% annualized return. Now the gain was a negative. Ooh, wait a second. It says that's a 6-month gain was down 67%. You'd have only made 10%. Well, for a market that's flushing like a toilet, that's down 67%, you still made a 10% annualized return, which is the same as the S&P 500. I guess you can't complain about that. The S&P in an up market. Okay, so it protected you in that Coinbase strategy. Winter actually made more than that. Well, look, it's not calculating a 6-month gain on here. That's gone to zero. So there's some math problem on that one. But it did have a yield of 87%. That's pretty cool. All right, there's some more in here. Let's go down to some that I am familiar with and like a little bit better. There's MSTR, MSTY. Okay, over the last 6 months, the yield has been 61%, right? The loss has been 49%. So see, even there in the last 6 months, if you'd have been doing this without any kind of protection to the downside, you'd have still made about 12%. So let me show you the other little calculator that kind of highlights this. This is called the break-even calculator. So if you come here to the break-even calculator, now notice the URL on this, or don't. Go pay your Pit News Magazine $39.95, and then you get this with your subscription. Don't pay any attention to the URL up there. Did you guys ever go what's it called? The Yellow Brick Road. Follow the Yellow Brick Road. Follow the Yellow Brick Road. What is that? Don't look at the man behind the curtain. Pay no attention to that man behind the curtain. This is the man behind the curtain right here. pitnews.com/dividend calculator. Right? Dividend calculator. That's all you have to type in. pitnews.com dividend calculator and dividend dash calculator. Don't forget to put the dash in there. And then it brings you this calculator, which you can only get if you only have a subscription to Pit News Magazine. That's my my development skills. I don't know how to lock it behind a password. If you know what the URL is, you can go to it. I just don't publish the URL to anybody, except for I just tell it to everybody on YouTube. So go buy Pit News Magazine. Yeah, Pit News Magazine, and then you get this calculator. All right. Anyway, let's come in here. Let's pick one of these markets. Let's come down here to, let's do AMD. AMD is a chip manufacturer. Let's do Tesla. Everybody loves Tesla. Tesla. All right. I got me a new Tesla the other day. I love it. Drives all by itself. Takes me to the university. I don't even have to touch the steering wheel. It takes me right to the university, and I can teach my class. Get in the car. Takes me right back home. It's pretty amazing stuff. It's the only time I ever leave my house. Go to the university to teach. Oh, I have a dog. We go for a walk too. All right, here we go. Let's go down here and see this little slider and see this little chart down here. Let's explain to what this is. So this little chart, the red line is Tesla, TSLA. That's your stock. So let's go look at Tesla. All right, TSLA. And I'm putting these in the Bitcoin. Hope you don't mind. I call this the Bitcoin portfolio, and now we're adding a bunch of other stuff in here. So it is what it is. It just is what it is. All right, so we're in Tesla. This is Tesla the stock. All right, Tesla the stock. So TSLA is the stock. So that red line represents Tesla the stock. All right. So what happens is we're putting $10,000. You can see right here, we're going to invest $10,000 into Tesla on the start date, whatever the start date is, happens to be today. All right. Happens to be 1 year ago from today. And Tesla, during this back testing example, all right, went absolutely nowhere. Went nowhere. Zero. You held it for an entire year, and you can see your income is flat. Didn't lose anything, didn't make anything. Now, you also took that $10,000, and instead of putting it into Tesla, you put it into TSLY. All right, TSLY. Now, this is TSLY. Now, I have a saying. If you trading is not about making money. What? I thought trading was all about making money. No, trading is not about making money. Trading is about not losing money. And until you figure that part of trading out, you'll never figure this market out. Trading is not about making money. It's about not losing money. If you put 10 grand in, you better have a plan to not lose it. Well, I'm just going to put it in there and hope for the best. Well, you're not a trader. You're not an investor. You're a gambler. All right. We talk about this in class too. We go through and we specify what type of traders everybody is. Are you a day trader? Are you a scalper? Are you a short-term trader? Are you a long-term trader? Are you a gambler? Are you an options trader? What kind of trader are you? And we go through and we list them all out, and we talk about the categories and what the different strategies are for different types of traders. All right. I'm a buy and hold trader, Land. I just put my money in there, and 40 years when I'm ready to retire, I'll be rich beyond my wildest dreams and fly off to Cancun every weekend. Okay, do that then. All right, that's long-term trading, and you can do that. But my bet is that it's a crapshoot. You don't know whether the market's going to be super high when you're ready to go to Cancun or whether it's going to be super low when you're ready to go to Cancun. You might have made a whole bunch of money up until you had to go to Cancun, until you want to go to Cancun, and then suddenly just timing just happened to be just wrong, and now you don't have anything left. It all went down, right? Because the market went down. Why? Because you're not protecting yourself. I'm just a buy and hold guy, Lan. It'll just be, I know that in 30 years when I get out, it'll just be there. Sure it will. Sure it will. Sure it will. All right. So the name of the game is not to make money. The name of the game is not to lose money. And if you're going to play the game not to lose money, then you also have to play the game so that when the market is doing well, you have to make money. So you have to make money when the market's doing well and not lose money when the market's doing poorly. So we have to have some sort of a strategy that helps us make that happen. Now, it doesn't have to be perfect because you can use a little bit of time. Time heals all wounds to some degree, and then it flushes. And so far in our history of the S&P 500, time has healed all wounds. We are making, in the Dow right now, we're making new highs every week, making new highs, right? Donald Trump gets on the TV. Oh, Dow just made new highs. So, right, he's very proud of that he, under his administration, the market's doing well. But that doesn't always happen. I know markets go down, whether it's Trump administration or Biden administration or Hillary Clinton administration. I mean, Bill Clinton administration. Markets have fluctuations and they go up and down. And the president of the United States really, well, I can't say doesn't have a lot to do with it because the last few presidents have had a lot to do with it. Quantitative easing, big debts. Congress does a lot of things that affects the cycles and trends of the overall economic future of the country, right? We all know that. But nonetheless, there's all these cycles and trends. And in the shorter term time frames, markets go up and down. They go up and down. And, over a long period of time, they've gone up. But we do have what we call black swan events where markets just flush like toilets for no reason, or some big catastrophic thing happens. Banking institutions go out of business or get too leveraged, or government has to step in and save their sorry asses, all that kind of stuff, right? So there's that type of event that you have to prepare for. And Misty had one of those events, and I didn't prepare for it. I was just letting the dividends, feeling, like I said, I was getting a little complacent because the dividends were so big, they were paying for my drawdowns. But then I had this catastrophic flush, and my dividends didn't pay for all the drawdowns. Now, I lost less than everybody else. I mean, if you were in MSTY, or if you were in MSTR, if you were in MSTR, you lost a heck of a lot more money than I did. Why? Because you didn't have any of these dividends coming in to help you offset the drop. All right. That's one of the nice things about having these big dividend funds is that when markets really flush out, the dividends help slow down that loss. And that's what this calculator shows you. So if we're going to use Tesla in this example, you can see that Tesla made zero. But if you were to put it into the underlying stock, which is TSLY, and we go over here to TSLY, okay, now this is Tesla and Tesla, TSLY. This is the dividend paying stock, all right? And then you got TSLA, which is the actual stock. Now, TSLA has been going down, right? It's been going down. And so if you didn't protect yourself to the downside, you lost a lot of money in Tesla through here. TSLY goes down, lost a lot of money in Tesla over here. But the difference is that this one was paying a big dividend on the way down, so you lost less. So this example right here, the whole idea is that this calculator tells you that in a historical example, if Tesla lost zero, you can see how much you would have made with the TSLY strategy of having dripped your money back in, continually reinvested the dividends back into the stock over a period of time where Tesla, the underlying stock, actually made nothing. All right. So you'd have still made $16,434. That's pretty cool. Tesla, the underlying stock, made nothing, but the dividend paying stock, because it pays those covered call strategies, paid $16,000 in profit. How is that possible? Because you're selling premium against the underlying stock that's going nowhere. So you got all that premium, $16,000 worth of premium over a 1 year period of time. That's 12 months. Okay. Now, if you would have just taken that money out and not reinvested it, right, not keep putting it back in to grow, well, you'd have been at this blue line and you'd have just taken out $15,000. So you put in 10,000, Tesla goes nowhere. At the current rate that it's paying out dividends, you'd have made $15,000 in 1 year, and Tesla made nothing. That's what this little calculator shows. Now let's come up here and see this little slider. You can say, well, what if Tesla lost money this year? Or what if Tesla made money this year? What would these two funds have done, or this other fund done? Take the money out or reinvest the money. So let's come down here and go all the way down and say, let's say Tesla lost 50% of its value, had a big, slow drop for a whole year and lost 50% of the value of that year, right? How much would you have made? Well, because you didn't own the underlying stock that lost 50%, you had the dividend paying stock. And if the dividends would have been equal, which they're not, they fluctuate. Remember, this is just a model. Okay, it's a calculator model. It's showing you how the market works. You would have made $11,000 with your reinvestments. So, or you'd have had $11,000. Not that's what your portfolio would have been. I think I misread that before. It's not. Let's go back to zero. I want to make sure I get that number correct. I don't want to be reading those numbers incorrectly. Okay, your account would be worth 16,000. So you put in 10, your account would be worth 16. So you made 6,000. All right. Tesla made nothing. You put your money into this one and it made 6,000. And then if you'd have taken it out, you wouldn't have taken out. If you'd have taken everything out, like I said earlier, you wouldn't have anything left. So you can't do that. So you have to leave the 10,000 in. Sorry, I was reading this incorrectly. Your account would be at 15,000, meaning you would have made 5,000 because you put 10,000 in. So let's fix that problem. Okay, that examples it, because we put 10,000 in at the end of the year, we have 10,000. We made nothing. So we put 10,000 in at the end of the year. We pulled 5,000 out. We didn't reinvest it, so we got 5,000. And then if we reinvest it, we got 6,400. Okay, so our account would have been 16,000. All right, sorry for the confusion. All right, so now we're going to take it and say Tesla actually lost 50% of its value. You can see the numbers up here. It's just more fun to look at the chart. Okay, so Tesla did really poorly. If you were in Tesla, you lost a whole bunch of money, unless you protect yourself, but you didn't, all right, in this example. And so what happens is your green line, which is the one of constantly reinvesting it, you would have made 1,690. You would have still been profitable. Tesla itself could have lost over a slow period of slow death, not a fast death. Fast death is bad. That's what happened to me. Slow death over a 12-month period. You still had a profitable trade, right? $1,690, whereas everybody else lost 50% of their value. They lost $5,000. You made $1,000, or almost 1.6. All right, that was reinvesting. If you wouldn't have reinvested, just take your money out, you'd have taken $1,328 out and still had $10,000. So your account would be $11,328. Now your account wouldn't be that, because in this blue line, you're taking that $1,328 out and you're going and spending it and buying things with it. All right. So that's the advantage of these funds. And that's why I got complacent with Misty. Misty dropped fast, not over a slow 12-month period of time, which the dividends could have kept up with. It went down really fast. It dropped like 60% in like 4 months. And the dividends just could not keep up. Now, could I stay in and time heals all wounds and maybe Bitcoin will turn and rally and come back up and my dividends will keep paying and then it'll go up and my dividends will keep paying? Yes. Time heals all wounds, or has in the past, historically speaking. Now, this is a different thing. This is not the S&P 500. This is an individual stock. So does time heal all wounds? Not necessarily. stock could go out of business, right? Or just have 10 years of bad earnings. It just might not go anywhere. It's tied to Bitcoin. Maybe Bitcoin will never come back. Maybe Bitcoin's done. Maybe it's history. A lot of people are saying that. I don't think so. I think Bitcoin's got a good future in it. So eventually these things should come back. And what happens if they do? Well, the market turns and starts to go back up. You get back to zero. And then what if the stock actually makes 10% or 50% instead of loses 50%? Well, now look at your numbers. Now your account. So this one makes 50%. So now at the end of the year, it's $15,000. Your blue line, how much money did you take out, is 19,000. So you took out 9,000. 10,000 still in there. You take out 9,000. And then this one, 22,800. If you keep reinvesting, that's your exponential compounded growth, right? This is why we got complacent. This is what we were experiencing. Remember, oh, they're so happy. Misty's making money like crazy. I never made so much money in my whole life. Oh my gosh, I'm so happy. Even on downtrends, it's just still paying for itself because the market does this, right? The market does this. It doesn't just go one. It's constantly doing this, right? So up and down and up and down and up and down and up and down. And that's what the markets do. They constantly move up and down throughout the year. They don't just go straight. This is just a model, but it shows you the idea, the concept of what happens. Okay, so that's why I got this little calculator, and you can go look at different funds, and they can show you the different dollar amounts based on that type of thinking. But it's those high yield funds that gave me a complacency that I was going to be okay, even with the market dropping. But this model is only for a year's period of time. What if it drops that fast in 3 months? Well, then these things are going to come tumbling down too. All right. It needs to only have a slow drift for these to stay positive. And it can't keep up with it if it comes down faster than that. And that's what happened to me and my Misty. So we need to protect ourselves against these, black swan events or these huge market reversals. And a lot of the markets are down right now. If you come in and look at just even the Mag 7, okay, let's look at the Apple. See, well, Apple's doing okay, but they're flushing again right now, right? Getting ready to flush. Look at Amazon, though. Amazon been in a nice, beautiful uptrend for a long period of time, just kind of a real slow grind, right? No high implied volatility, which is what you need to get those high dividends, just kind of low dividends, but still nonetheless positive dividends, and that's a good run. But this, suddenly flushed like crazy. It's like, oh my gosh, what's happening to Amazon, right? So Amazon, and then you got, we got American Express in here, but it's not one of the Mag 7. But you got Google. Google's been way up there, right? Google's been way up there. And you're like, well, I got some Google and I have loved it and I'm making money. Yeah, but it's flushing like a toilet right now. You better get some protection in there. We don't have any idea how far down that thing's going to go. Now, it could just come down a little bit, get to 38.2 and go back up again. Could very well do that. Or it could come down here, give you a little hope, and then flush one more time. Give you a little hope, and then flush one more time, right? We don't know. So what if it does do this? Well, we got some mathematical models that tells us, well, you better start putting on some protection because this is getting nasty, right? This could get really nasty out here. We don't know how far it's going to go. They've got good news. They got good earnings. They're making money. But you know what? We got to talk about the Wyckoff theory. Not today. Wyckoff tells us we have to. Okay. Wyckoff tells us that markets are driven by large institutions, right? And large institutions, we all know, buy low and sell high. So this is the little image that I always show you for that. And big institutions build upside right pyramids. They do this. Small traders, we do this. We buy low with a small amount, and as the market rises, we keep buying all the way up the uptrend. Well, big institutions, when the market's coming down, they buy all the way down, and then when the market goes up, they sell all the way up the uptrend. So if you're buying, who's selling to you? You got to ask that question. Hey, if I'm buying into this market, who's selling to me? Who's willing to lose money so I can make money? Because it's a one-to-one market. For every buyer, there's a seller. And if you're the winner, somebody else had to lose. And so you have to ask the question, well, I'm so excited to buy this. Why is there somebody else who's excited to sell it to me? That might make you pause for a minute, right? Why would somebody sell me this? If it's so good of an investment for me, what's the point of them selling it? Usually it's the large institutions who are selling, right? Because they build a big, strong base. They load it up on a whole bunch of shares down at the bottom. And then as markets rise, they sell all the way up the uptrend. Buy low, sell high. What a concept. But yet that's not what retail traders do. We start buying low. We're good at that. We know when markets are low, we start buying them. But then as markets rise, we don't sell. We buy more, and then 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 we buy more. And this is the basic concept of the underlying structure of what we call the Wyckoff accumulation distribution model. Okay, this is the core of that concept. So big institutions, they buy low down here, all right, and they buy a whole bunch. They don't just buy one or two like you and I. They load up, man. They back up the truck. They buy all kinds of them down here, and then they start to sell out all the way up here. Sell, 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 sell. So by the time the market gets up into this region here, who's holding all the positions? Who's holding all the positions? All the retail traders, upside down pyramid. Who's got rid of all their positions? All the institutions. The institutions don't have any shares up there, and they're not going to buy up there. So if you start trying to sell because you're worried the market starts to go down, then they ain't buying them. They ain't going to buy them from you. So you're going to have a hard time selling them, but you're going to sell them, and probably some other retail trader will be the only buyers because they ain't going to buy them. The banks and institutions, they're not going to buy them. So what happens is that forces this market to come down, 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 down until there's no more retail traders to sell or to buy down here, right? And you've sold out all of your positions. Retail traders have been buying them on the way down, so they're getting destroyed. So retail traders lose all their money all the way down this big downtrend. And then who starts buying in again down here? All the big banks and institutions, right? They know how to buy low, sell high. So they're not going to, they got no more shares up there. So they just leave the market. They just walk away. Well, we made all of our money, sold out, nothing left. So they leave the market and leave the retail traders to dwindle and die on the vine. And down we go. We tumble all the way down, selling back and forth to each other, trying to get in and out of the market as the market does nothing and falls because the big institutions have abandoned the market. But they don't step back in and start buying again till down here. And then it all happens again. Then the whole thing just starts to roll and starts to go to the, just starts to roll, and they buy a whole bunch here, and it starts to go back up when they start to buy down here. And then all the retail traders start to buy it, and they start to sell out again. And it rolls over and over and over and over. You go back, look in history of these charts, and you just see that same pattern go over and over. That's called the Wyckoff accumulation distribution model. And I show it on every single class. This is it right here. That's the bearish one. Let's look at the bullish one. So this is it. It goes through the accumulation, it rises, it goes through the distribution, it falls, goes through the accumulation, starts to rise once again. It's a simple little concept of buy low, sell high, upside down pyramids versus right side down pyramids, but it's the basic structure of the entire stock market. And so that's why we can draw a model like that, show it up there. We drew that model 30 years ago, and it still works. So this is the process right here. So what you have to do as a trader is you have to make sure that you are protected to the downside. All right. So you're not just selling out because, well, I'm losing money, I guess I'll sell out, get out. No, you got to protect yourself or hedge your positions so that you can maintain your positions so that you make as much money as you're losing all the way down, so that when you get to the bottom, you can take your hedge off. And then those positions that you had can start making money once again, going this direction. And that's what this whole thing is all about. That's why we do all this work. That's why we study. That's why we learn about this type of thing here. Now, the problem is with these big high yield funds, I got complacent. I got complacent because of this right here. The markets don't always go up, but I had the experience of the markets going up, right? We started these things, they're only a year old. They're only 2 years old at the most on some of them. So when we got into them, hey, they were making so much money. Even when markets go down, I was still making money. Couldn't believe it. It was the greatest thing ever. And I didn't have to hedge. I didn't have to go out and buy puts and buy options and do all the things that I've always done in the past to protect my downside position, because they were doing it. They were controlling that. They were making that happen for me. But suddenly this thing went down, and it went down a lot faster than I can draw on this chart, and I started to lose money. And I started thinking back to my olden days. I got to protect myself. I can't rely on the dividends to protect me in a down market. They're not going to do it. They're not going to be able to keep up. All right. And so you end up with a situation, if we go over to Portfolio Matrix, which is the true test of time, and we pull up our little chart. Let's pull up something like MSFT. What's Microsoft is a, well, you know who's a, let's go look at Palantir, PLTY. I made a lot of money in Palantir, was one of them, but Palantir is now flushing. Look at how bad Palantir went to being one of the best to one of the worst. Look, the gain on Palantir over the last, because of this nasty flush out right here, they're down 60%. Oh my gosh, they're killing us. Their yield, yes, 57%. That's a lot of money, 57% annualized return. If anybody could get a 57% annualized return on their dividends, they'd be happy as pigs in mud, right? You'd be so happy with a 57% annualized return. Problem is the gain is going down to 60%. So the gain is outperforming the yield. The yield can't cover that loss. So even though it's going down, and yeah, it's covering it, it's still losing 3%. You're still losing money. Still losing money with one of the best stocks ever. But that's because it flushed out. Did you see it? Let's go look at it. I'll show it to you. PLTR. Look at that thing. What stock looks just exactly like this? I mean, we're ahead of the curve, right? I mean, this is right now on Palantir. What other stock looked just like this? And we're thinking, oh, well, it's fine. What does that look like? What does that look like? That's Apple. That's Palantir. Apple, Palantir. Let's go look at Amazon. Let's go look at Google. Let's go look at Palantir. Let's go look at Google. What are we getting a precursor? Are these other funds going to flush like that? Now this is NVIDIA. Quit doing all this auto scale crap, you stupid computer. I just need to turn that feature off. All right, Palantir, NVIDIA, Palantir, NVIDIA, Palantir, Tesla, Palantir, Tesla. Are we getting a foreshadowing here? Does it feel like a foreshadowing? Microsoft. You didn't think Microsoft would ever fall. That's a great stock. It's never going to fall. I'm putting my money in Microsoft because it'll never fall. Palantir, Microsoft. All right, let's not use Palantir as our gauge. Microsoft, Apple, Amazon, Google. Maybe we better protect ourselves to the downside. What do you say? Because these markets are flushing out like we never thought they would. Never thought Microsoft would fall like that. Never. I never thought it would flush that hard, that fast. We think it would go down? Yeah, we thought it would go down. Do we think it would flush that hard, that fast? No. If we go over and pull up Microsoft in our little calculator, where is our calculator? MSFT. Gain, negative 2%. Yield, they don't have one. So it's down 1.2%. Gain is down 2%. That's from the beginning. So that whole year, you lost everything. You've lost everything from that massive run. I put all my money in on the first of the year. I bought low down here. I rode it all the way up. Made a ton of money. Now it's all gone because I'm a buy and hold guy. Time heals all wounds. Well, your wounds were healed here from the last time it flushed down like a toilet. You got your wounds healed. Did you get them healed? And now the market's flushing again because you're a buy and hold guy. You actually went through that entire thing and didn't make a damn thing. You're down 1.2% now. At least if you'd have done the dividend version, you'd at least had the dividends, right? Let's go back over to our little dividend calculator. Which one is it? It's this one. Not that one, this, not that one, not that, this one. Let's go Microsoft. MSFO. So let's say Microsoft lost 1%. Okay, let's say 2%. Well, Microsoft, you'd had your $10,000 would turn into $9,800. If you'd have put that into MSFO, which was the dividend version of that, you'd still have $2,000. Now, the thing is this didn't just drop to, this is the year time frame. This is where the end of the year, you had a huge amount of money, right? It went way up, but then you lost it all because you didn't protect yourself. Now, if you'd have been in this fund, you'd probably had a lot more than this. This is just if the market went straight down. This doesn't take into consideration the market went way up and you made a whole bunch of dividends and profits and then lost it all. This is only if the market just went straight down. Okay, so this is not true, but even in the worst case scenario, where the market just lost 1% over the entire year, you'd have still made $2,000 if you'd have done your reinvestments. And if you'd have just taken the money out and gone and spent it, you'd have made $1,800 over the year's period of time with a 1% loss on Microsoft. The dividends would have paid you $1,800. Now, what if let's go and say, well, what if the market did go all the way to 50%? It made 50%. It was probably about what it did in the middle of the height of the thing, right? Well, you'd have made $15,000 or $5,000 in profit because you went up 50% of the value of the $10,000. But your dividends made 17. So you made 7,000 instead of 5, right? This would have been 5. This would have been 7. So you made an extra $2,000. This one, if you'd have just taken the money out, you'd have taken $6,000 out and gone to spend it over the year on $10,000. That's 60% annualized return. That's pretty darn good. 64%, it says it right there, right? Cash out, 64%. We reinvested it, it would have been a 71% annualized return. What did Land Turner make? Land Turner right now, if we go look at his account, pull up that dashboard. I'm going to pull it over here. It always shows my account numbers. I don't like that. I don't know if it matters, but I don't like it. If you know my account numbers. So Land Turner is sitting at, where's the number? Oh, there it is. 58%. So that's where those numbers come from. 58% annualized return on that account. And 68% annualized return on that account. It comes from this type of a investing calculator. Where is it? Right here. So it's this little calculator right here. Except for mine's real money. It's not just this model. Mine, real money. Happened real money. Okay. All right. That is your break-even calculator. And we're going to be talking about, well, we got to talk about it right now because we talked about all this stuff. Now we got to talk about how you protect yourself to the downside. Protecting yourself to the downside is the key here, right? Now, this is what I'm working on, okay? I've got a little calculator, and I'm going to show you the calculator. It's not finished, all right? It's not finished, but here's the concept. Let's go back over to our calculators, and this is the one that I'm working on. Where did it go? Where, oh, where? There it is, right there. So this is the calculator that I worked on all weekend, and the new version looks. I don't want to. It looks like this. I'll show you these little mini ones. These little charts up here. This is what they look like. Okay, this is what they look like. So it's going to be part of Pit News Magazine, and it's going to. I'm taking all these calculators and I'm putting them under one place, so you can just have all these, and they're going to kind of work together. All right. So I have big plans, but I got lots of programming to do. Fortunately, I've got AI to help me, and I'm able to go a lot faster than I used to be able to when I did this with I used to have a software computer programming company. I had like 20 employees, 10 computer programmers, 8 computer programmers, and the rest were support staff to support all the stuff we were doing. I sold that, but now I have AI and all these new great ideas that I've got. I can now kind of, me and my son can do them ourselves. That's why we're going to have a big special live seminar. You got to come to the live seminar. It's this weekend, Saturday. Here's the brochure. All right. It's called How to Build a Powerful Income Portfolio to 2026. This is take money out, not putting it in. Strategies that separate winners from wishful thinkers. All right. Live in-person seminar sponsored by Portfolio Matrix and Pitt News Magazine. Join us in exclusive in-person seminar with real money traders. Most investors chase yield without understanding the risks. The seminar shows how professionals actually build, manage, and protect high-yield ETF portfolios in live conditions. No theory, no fluff, just strategies that work and warnings about what doesn't. Here's the information, all right? So here's how much it costs. It costs $199 unless, of course, you own Portfolio Matrix. If you own Portfolio Matrix, well, it knocks $175 off the cost of the seminar. You only have to pay $39.95 or $25, all right? $25 to get in if you own Portfolio Matrix. But what if you own Portfolio Matrix and you own Pitt News Magazine? What if you have a subscription to Pitt News Magazine? Well, Pitt News Magazine is going to pay for your dinner, which is $39.95 otherwise. So for all Pitt News Magazine subscribers, it's free. Dinner is free. Dinner's free. We're going to buy you dinner, all right? And the seminar is free for those people who own Portfolio Matrix. So if you own Portfolio Matrix and you own Pitt News Magazine, you can come to the seminar for free and get a free dinner. And we're not even going to sell you anything because you already bought everything that we have to sell. It's not like you're going to come there and we're going to try and sell you something else because we ain't got nothing else to sell. You already bought it. So it's free. And that's the point. We're showing our customers, it's a customer appreciation seminar. So for those people who own Portfolio Matrix and own Pitt News Magazine, we got a live seminar for you this Saturday, and it's going to start at 1 o'clock in the afternoon. 1 o'clock, February 21st. It's going to go to 5 o'clock. 5 o'clock is when we're going to go eat. And then we're going to go down to the all-you-can-eat Chinese buffet down there on the boulevard, Ocean Buffet. So it's like it's like all-you-can-eat sushi, all-you-can-eat crabs, legs, and fish, and plus it's got like they got all kinds of stuff. So they got like all these desserts. They've got pork ribs, if you like barbecued ribs. They've got all the Chinese food. It's really good. A great big buffet. If you haven't been there, don't go until you come here. Let this be the first time you come with us. We'll all go there together. All right. So we're going to have a dinner. So hopefully you guys will come. How do you pay? If you need to pay, and you're not going to buy Portfolio Matrix, but you want to come anyway, or you want the dinner, you have to pay at the door. So just show up and you can pay at the door. All right. So if you want to come, but you don't want to buy Portfolio Matrix yet, don't let that stop you from coming to the seminar. It's just $175. You just pay $175 for the seminar and $39, and you can join us for dinner. So you pay the $199, and you don't have to buy Portfolio Matrix or Pitt News Magazine. And Portfolio Matrix is $24 a month. Pitt News Magazine is $39 a year. Right now, I can tell you, once I get all these calculators, Pitt News Magazine is going to go to $99 a year because I can't do all of this programming for $39 a year. That just math doesn't work. All right, so it's going to go to $99 a year. But anybody who has Pitt News Magazine, they're going to be grandfathered in at $39. So your price won't go up. It'll stay at $39 as long as you have the magazine, and you'll get all the calculators and everything that everybody else is paying $99 for. All right, and then you have Portfolio Matrix, which is this portfolio where you track all of this hooks up to your actual account, and it does all this mathematical stuff. So it's really cool. So this costs $25, something like that, $25 a month. And that's in the beta version. It'll go up too. It'll grandfather you in if you get it early. So it's not quite done yet either. We're all working on this stuff. It's all neat new stuff we're all building. So come and join us at the live seminar. This is going to be a blast. This is Ben. He's my son. It's a father-son duo. He's a Series 65 certified financial advisor, educated, trained guy. So and then I teach at the university down here. So it's the two of us. And we think we're going to have it down here at the Hyatt Regency in St. George. Now, we're not exactly sure because this hasn't been confirmed. I go down after this class is over and confirm that we're going to be at the Hyatt Regency. So if I go down to the Hyatt, it's not the Regency, it's the Hyatt Place. If we go down to the Hyatt down here in St. George, if I go down to the Hyatt and it's not there, and we can't get that confirmed to be there, we got a meeting with them. We're meeting with them, and if it doesn't work out that we're not going to be there, I'll have to let you know a different place. Okay, so watch your emails. I'll send out emails to everybody. You're going to have to check with us. This information will be on the website at Pitt News. We'll put it on there as soon as we get everything confirmed. Right now, we don't have everything confirmed, so it's not on Pitt News Magazine. But make sure you go to pittnews.com before you go down to the seminar, because the location might change. Nothing else will change, just the location. We're thinking of a golf course out north of town, out by Ivans too. So it might be at the golf course in Ivans. But we're going to try and do here first. And then if we can't get that, we may end up at the one right next to it. See this one? There's one right next to it. That's just a Holiday Inn. We'd rather go to the Hyatt. So anyway, we'll let you know the location. But we believe this is going to be it right here. Okay, I go confirm it after this class is over. All right, so what we need to do now, I want to take you down. I want to show you the little calculator that we're working on. Okay, so we're going to be, hopefully I have something a little updated by the seminar. I want to show you this in the seminar too, but I got a presentation. I want to teach you the whole concept in the seminar about the how to protect yourself to the downside. It's all about hedging. So what we want to do is we're going to come in here and I'm going to show you this neat little trick. We're going to run it through one time. But I need to have the numbers, and the numbers, that's one of the problems that we have, is getting all the numbers. The numbers are not easy to come by because you have to go to like 6 different spots to get them. So I'm going to try and make that so it's not 6 different spots. So first of all, we're going to pick the chart that we want to protect. Now we don't want to protect Microsoft. It's already too late. We did not do that one. All right. We have to do one that was getting ready to flush. Apple. Okay, let's say we're in Apple. We got to protect ourselves to the downside. How are we going to do that? Well, we're going to do it with APL. Now, again, what is the symbol for Apple? See, I have to go somewhere else to find it. Let me see if I can find it real quick here. Oh, that's not going to do it. I'm off the screen here. Sorry. I'm going to find it. Single stock ETFs, the one we were interested in is Apple, APLY. It's APLY. So let's come over here. This is APLY. This is the Yield Max version. Okay, so this is the one that pays the big dividends. And it's already flushed. But it's got more to go because look at the real underlying Amazon. Well, that's the flush right there. So that's it just looks worse over here because it's scaled funny. It's like that. Okay. So that right there, this flush here is this flush here. Now it's pulled back and it's getting ready to flush again. Maybe. We don't know. Maybe it'll only come down here and it won't break this low, and then it'll turn and go back up. And that's okay. If it does that. If it does that, that's all right. It's called a butterfly pattern, incidentally. It comes down here, goes up there, comes down here, goes up there, comes back here, and that's why we call it a butterfly. It looks like a butterfly, but then that flushes out there. Okay. So if that's what happens, let's get rid of all these drawings. Land's got so many little things that run through his head. I got to get all this stuff into a computer program before I die. You know, I got so many ideas. I've been doing this for 40 years and I've wanted all this stuff. So many things I want to get done. And now that I've got AI, I can do it. But I've had to pay a staff of 10 programmers to do it in the past. Now me and my son can do it. So we're working as hard as we can. We're working as fast and hard, bones to the finger, boy, fingers to the bone. All right, so this is the one we got to protect ourselves against right here in case that thing goes down. So what's the underlying is APLY. We got to protect ourselves in case that thing makes another tank way down in here, like what we might anticipate if this one follows what Microsoft did, right? Microsoft. We had the flush, it ran back up, and then and this is where we're at in Apple right now. Right now in Apple, looks like we're kind of right here, doesn't it? Now, maybe this market will start to turn and go back up right down here. And maybe Apple, that's as far as Apple will go, and it'll go up right here. I don't know. But because we don't know, we need to protect ourselves, right? We need to put something in there to protect ourselves. That's why we're going to come over here and we're going to go into Apple and we're going to go down and we're going to go to the options chain. And we're going to come down here and we're going to say, I'm going to buy a put. And this is puts. And we're going to go about 100 days. We like about 100 days. 150 is too far. 87 is too short. But this one's not dark. 121. See that? See how it's not dark? We don't want that one. Why? Because it's not got a lot of, oh, it's not bad. It's not bad. Because it's Apple. 87. But look how much better this one is. 10,000 at the monies. Versus 87, we go to 121. Oh, 15,000. It's $1,400. We might not be able to afford it though. We have to go to 87, 1,200. Let's put it into the calculator and find out. That's what we really need to do, right? We need to put it in the calculator and find out which one we can afford. Let's do the 87 days right now. So we're going to do 1,250 put, and we're going to do it. We can do it at the money. We don't have to do it at the money, but we're pretty nervous that this thing's going to fall. So we're going to be a little bit more aggressive. We're going to buy a little bit more expensive insurance because everything else is already flushed. We're worried this one's going to too. If we weren't as worried, we could go down, we could buy a little bit less insurance. Remember, that's what this is, an insurance policy. What's our deductible? You know, if you keep buying the best insurance in the world, eventually you're not going to make any money because you keep spending it all on insurance. So we can buy less expensive insurance, but if the market actually does fall, then we have to pay more out of our pocket and we lose anyway. So it's like we want insurance, but we don't want to have so much insurance that we spend all of our profits on insurance. But we don't want to have so little insurance that if the market does flush, we just blow all of our money. Should have had better insurance. So right now we think the market, I'm really worried this market might flush. All right. So I'm going to buy some good insurance. This is called an at the money put. So we come in here and we're just going to come in and we're going to buy the put. And you just drop it in. The way that do it, track and trade is really easy. You can either just do it right here. You can just right click and say buy, right? And that puts your little calculator on. If you hit buy, that doesn't actually send it to the market. It puts it up here on the screen. Uh-oh. What happened? Oh, it's back. Going invisible on me. All right, so there's our order. We got it right here on the screen. So you can see where it doesn't actually send it. When you hit buy down here, I wish it wouldn't say buy. I wish it would just say add. So anyway, you can add, you can buy, or you can sell. You just have to say add buy or add sell. I don't know. Anyway, it doesn't really buy it until you hit place order right here. Okay, but we're going to buy it. We're going to buy a put option. So that means you make money when the market goes down. And what it is, it has a delta right now. I'm not going to get into this in great detail because it's a little bit more, and I have a class that comes up, an options class at the university. And so we'll get into this in greater detail when I start teaching the options class down at the university. Plus here in the lab, I'll go in greater detail too. But this is just the basic idea of the calculator, because we had people saying, well, show me the calculator, Lance. So it's got a delta of 43 right now. So it's only going to cover you as if it's trading 43 shares of the underlying stock. But eventually, once it gets to that purple line, it'll be 100 shares. So don't worry about it. It'll cover you if it goes all the way to the purple line. You might not have to go to the purple line, and that's okay, because then you can sell it out and get some of your money back. If it went to 100 right now and you had to sell it back, you wouldn't get any money back. So it's good that it's only doing 43 shares. But it's gonna have this little gap in there where it looks like you're losing money when in reality you're not. All right, because it's only covering 43 shares, but the delta will go all the way up to 100, cover all 100 shares when it gets closer to that purple line. The closer to the purple line it gets, the more shares it's covering. All right, automatically. You don't have to do anything. Just you buy that one and it just does it. Okay, so 1,255 is the cost of our options to protect us to the downside, and that's going to protect 100 shares of Apple. But we're not going to be in Apple. We're going to be in APLY. This is where our money is. Our money's over here getting dividends. Well, we need to know how much the dividends are. Well, track and trade doesn't tell you. So we have to go to another program. See, this is what I want to fix. I don't want to have to keep jumping all over the place to all these 10,000 different locations just to find how to fill in the calculator. And we should just be able to let the calculator, AI, come on, AI, just do it. So now we have to come over here and we have to go to APLY and we have to find out what the dividends are. So the dividends are currently trading right here. Get out of the way. Are currently at a 17, 5, 4, 4, 4, 17. Wow, went way up. Implied volatility went crazy. I don't know if we can trust it to be 17 for 100 days. It averages every week about 5. There's 6, 4, 5. There's 11. That's that's unnatural because of all of the volatility. It went all the way to 17 when we're usually sitting here at 5. Let's not count on having 17 for the entire duration. All right, let's go back to something a little bit more realistic, like 5. Most of these are 5s. What is it when it's going up? 11, 13, 11, 6. So the market goes up, we get it, but its market's not going up. We're going to think market's going down. Let's do 5. Let's do 6. We'll do 6. We'll say we're getting 6 every week. We're getting a 6% dividend. So, so now we go back over to our calculator and we put these numbers in. Okay. So yield max price, Tesla, currently trading at, it's not Tesla, this is the one we're trading at, is Apple, which is $12.30. So we're going to put in $12.32. The underlying stock price, that's what Apple's going to be. The underlying stock price is currently trading at $261.84. 261.84. And the cost of one underlying put option, we decided we were going to do the one right at the money. So it's going to be 12, this number right here, 1,245. So it's 1,245.00. And then we're going to do the estimated dividend per share. We said it was 0.5. We're going to point to 0.6. We said we were going to do 0.60, right? So dividend per share and the trade duration, these are, how long did we decide we're going to go for? 87 days. So it's 87 days. 87 days is our option. And this comes in every week, all right, because it pays the dividends weekly. And when we hit calculate the hedge. Now what this does, it comes down here and it says this is your hedge ratio calculator. So it's 2,121 shares is what our option is going to cover. Now, because we're buying the option, why don't you buy the option on the APLY fund, Lan? You can't. There's no options there. There might be some, but the volume, the spread is so wide, you can't do it. You have to do it on the underlying stock. This is pairs trading, remember? Pairs trading. So we do the options on Apple itself to protect us on Apple, but the money that we get from Apple is going to cover the losses that are going to take place over on APLY, on your underlying yield max fund. And what's going to happen is the yield, right, the dividends are going to pay for the cost of the insurance. And then we're going to make money, just as much money on the way down as we're losing on the way down. It's like, why don't you just get out of the market? Well, you could do that, but this should make you a profit. All right, let's go and see. The whole idea is to make money when the market goes down, not to get out of the market. You can get out if you want. You're not going to make any money if you get out, right? But you'll save from losing money. That's always good. But you need $27,000 of capital to make this strategy happen. Why? Because you got a big old option over here that's got to make enough money to cover the cost of the losses over here. So if you don't have $27,000, you can't do this particular hedging strategy. That's just the way it works. Sorry, that's the way it works. One underlying put contract protects $26,000 of value, right? Stock times 100. Since one fund share costs $12.32, that single put option covers roughly of the fund that we're in, which is APLY, is $12.32. And that single put option covers roughly 2,126 shares. So you need to have 2,126 shares. Otherwise, you're buying way more insurance than you need, which is fine because if the market actually does fall, you'll make a lot of money because you got lots of insurance. But what if the market doesn't fall? Well, then the insurance is way too expensive and the market goes up and the dividends can't pay for it because it's too expensive. You don't have enough. You don't have enough. All right. So the total cost of shares and the hedge is $27,000. You have to have $27,000. And see, this is a profitable hedge. You put this on, it's going to make you money. It's profitable. All right. Total gross income is going to be $15,000 less the insurance cost of $1,245. This is over the how long period of time? 87 days. So over the 87 period of day, with your $27,000 investment, you're going to make $15,000. And then you're going to lose, or you're going to pay for insurance $1,245. The net profit on the hedge is $14,000. Annual return 53. Annual realized 223. That's not right. We got something wrong. Oh, it's not 60. This might screw everything up. It's 060. Oh, that's a big difference. 60 cents versus 6 cents. I I was getting all excited. Okay, here we go. Watch out for this one. Boom. It might not even be good. Oh, it is still profitable. Okay, so we got 2,126 shares. We still have $27,000 that we have to cover the cost of the shares versus the so you have to have $27,000 invested in APLY for this strategy to work. All right. So it's still a profitable hedge. The cost of the shares in the hedge, 27,000. We got that. Gross income, you're going to make 1,583. Now it's starting. Now it's making more sense. I was getting too excited there. Less the insurance cost of 1,200, meaning the net profit on the hedge is $340, or actual return is 1.24%, or a 5% annualized return. So it still says you're going to make a 5% annualized return with this strategy if the market flushes out and goes down like Microsoft did. Still going to make 5%. But if you stay in and keep all your shares and it turns and goes back up, well, you just have to pay for part of that insurance premium, and you don't have to pay for the whole thing. You can take it back off and get some of that money back, and then you'll be making money on as the market rises. But if the market falls like a toilet and you're like, well, why don't I just get out, sell the whole thing? Well, then you have a taxable event, and then you have to pay 22% of whatever you made this year on taxes. Well, what if it's a loss? Well, then you get to write those off against your gains on your other markets. So if you do have a loss, you can just liquidate it and use that as a tax loss harvest. All right. Now, if this all sounds way too complicated, I know it does to some degree, but it's not that bad. I mean, if you just stick with me and go through it, and you can learn to do this yourself. But really, you have to do it on anything you trade. I mean, it's not just like, oh, well, I'm not going to trade those high yield funds then, because you have to protect them to the downside. Well, you have to protect Apple to the downside too. You do the same thing. You just buy in a put option in case you mark the falls, right? You just got to buy your put option. We're just doing it on the underlying stock, and we need to mathematically calculate how much is which so that we can get those big dividends. If you don't want big dividends, then don't do that, right? If you don't want a UBI, universal basic income, you don't have to trade these high yield funds. But if you're going to trade the high yield funds so you can get the universal basic income, you have to protect yourself to the downside, because if you don't, those dividends can't keep up with the big fall. Sometimes they can. Like through here, it probably kept up with it. It's just a small fall, and then it came back. You'd probably been okay doing that one. But what if Apple flushes out? What if Apple flushes out and you got a whole bunch of money in getting the big dividends off of APLY, and this thing flushes out? Well, those dividends at 6 cents are not going to cover the big loss if it looks anything like what happened to Microsoft. I mean, this is nasty, right? What about Palantir? This is making me cry. I don't want to see these big funds fall like that, but we knew they were going to. I mean, it's part of the accumulation distribution model. We predicted it, right? We drew our charts on it. We know exactly where we come to this class. We were predicting all this stuff. All right, guys, that's all I got for you. I'm telling you, the seminar, we're going to go into this in greater detail, because that's what my speech is all about, is about how to do this hedging stuff. I got slides, little PowerPoint slides. I'll show you examples, and we'll talk about it in the theory, and then we'll play with the calculator. We'll do another couple of these examples, and hopefully I'll have a better piece of software so you're not chasing all over the world looking for answers. But we can just have the calculator do it for us. But that's the whole idea, right? The more information I can give to you in one single place makes your trading easier, and you're not chasing all over trying to remember everything you have to do. But it's all right here. It's all right here. And this will tell you if the hedge is not profitable too. It'll come in and say, don't do this. This is not going to make you any money. So it'll give you a warning. If you put all the numbers in like we have here, it'll come down and say, this is bad news. Go figure something else out. This strategy is not going to help you. You're in trouble. Probably just sell everything. It doesn't tell you what to do if it's wrong. It just says it's not going to work. It just says you're not going to make money. And you might do it anyway, because at least you'll lose less money than you would if you didn't do anything. I mean, it'll show you how much you'll lose. It'll be down 1%. Well, you can still do the strategy. Being down 1% is better than being down 30%, right? At least the strategy kept you from losing 30%. You only lost 1%. This is actually profitable. This is actually, you put this strategy on, you're going to actually make money. You're going to make 5.2% annualized return, or 1.24%, which is just going to protect your position, over the 87 days. So it's not going to really make you a lot of money, $340, but you're not going to lose 30% either on a big old toilet flush like you'd get right here, right? So, all right. I guess that's all I got for you today, guys. Don't forget to come to the seminar. We'll talk about it again tonight. Tonight we have class at the university, and we'll talk about the seminar. I got another presentation for you tonight that I'm excited to show to you and to share with you. And so, plus we got a guest speaker coming. We might have two, but we got a guest speaker coming, one of our previous students who's been trading these strategies along with me, and he's going to show you his portfolio, show you how he's been doing it. And he's just one of our students, not me, with 40 years of experience. He's got a lot of experience too. So I can't say that. He's been trading these not these particular strategies. He's been trading for a long time. But he just started trading these when I did, and then he just wants to show you his portfolio. He agreed to show you his portfolio and show you how he's done. All right. So that's what we're going to do in class tonight. I'm looking forward to seeing you there. I'll do a little bit of a presentation, then we'll turn over the time over to him and let him speak. And then on Thursday, we got Ben coming in for the class. So he's going to teach at the class. So anybody who can make it to the class at the university that night, make sure you come to your class, right? Ben's going to speak for that hour, and then we're going to have the seminar on Saturday. He's going to follow up and finish, and he's got a nice presentation to show you how to do all this really cool stuff too, to manage all this stuff in his software. So, all right, guys. And again, the seminar is free and free dinner for those of you who have Pit News Magazine and Portfolio Matrix. And it's not going to be a big sales pitch because we ain't got nothing else to sell you, because you have to own it to get there. It's customer appreciation. All right. And that's it. I guess we'll see you there. I guess I got one thing I need to show you here. One more thing before you guys run off. First of all, if you want to hit that like and subscribe to the channel so you get notified, and if I did a good job, you enjoyed what we did today, hit the little like, the thumbs up thingy. That's always fun to see. I like to see it if people enjoyed what we learned here.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, that's it. We will catch you guys. Let me go make sure comments. Let's look at the comments. Oh, we got some good comments in here. Okay. All right, guys. No questions. So I guess we'll let you go, and we will see you tonight in class at the university. Take care. And for those of you who don't come to the university, I've already gone to the class from last semester. We'll see you on Saturday. We're going to have one more class on the YouTube. Well, tomorrow we'll have a class because we got to do the day trading. So tomorrow afternoon, power hour, we'll do a class. And then Thursday morning, we'll do another Thursday. Well, it'll be Friday morning. Friday morning, we'll do another class. Morning class, and then Saturday we'll do the live one down at the hotel, at the conference center. All right, guys, that's our schedule for this week. We'll see you.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pit News Magazine.
Oh yeah, definitely subscribe to Pit News Magazine. You'll thank us later.